Good morning, Flagship Harbor Advisors. Eric Jefferson with the core team. Today's Monday, February the 7th, 2022. Just a reminder, this replay is for advisor use only. Busy week last week, S&P up about 1.5%. That is the largest weekly gain year to date. That was led by energy, CD, and financials. Although year to date, S&P is still down about 5.5%. NASDAQ down almost 10. And you have emerging markets that are virtually flat. A lot of red in the fixed income world as bond yields have continued to rise. Major headlines for last week, though, as we talked about in our annual outlook, think the road ahead is going to be one where fundamentals start to matter again, things like earnings. And we saw that really play out with two very high profile tech companies. First, we had Meta, that is the rebranding of Facebook. They had some poor Q4 results coupled with some even poorer forward-looking guidance. You saw their stocks sell off 26% in a day. That wiped out a market cap of $230 billion with a B. I think I saw a stat that is larger than almost all but 30 of the S&P 500 companies. Again, you saw that get wiped out virtually overnight. Facebook CEO Mark Zuckerberg saw his net worth decline by about $30 billion in one day. On the flip side, Amazon had some very encouraging results. Former CEO Jeff Bezos, his net worth appreciate by $20 billion in a single day. So again, we talk about the old Warren Buffett quote, rising tide lifts all ships. When that tide goes out, we see who's swimming naked and who isn't. I think that is certainly an environment that we are going in today. Companies are truly being punished this earnings season if they've not been able to deliver strong results. We think that is a trend that will certainly continue going forward. Turning internationally with respect to fixed income markets, saw the ECB, interestingly enough, hold rates where they are. Bank of England raised. And one reaction, not necessarily all that surprising, but you saw the longer term US Treasury yields actually increase. And again, that is a function of net selling. And the thesis there is that for European investors, where a lot of their yields were negative, it was worth them converting their assets into US dollars, buying longer term treasuries that had arguably kept our longer term rates artificially low. And so now as you're seeing higher opportunity for European investors to invest domestically, thought process there is net selling obviously put downward pressure on prices, upward pressure on yields, as again, those dollars are now making their way back over to the Eurozone. That hasn't necessarily steepened our yield curve, although the thought process is that has somewhat slowed the flattening. And that actually translates to two trades that we made in our tactical portfolios, where last Thursday we added to international stocks as well as increased our position in financials. That was funded by three positions, high quality mid caps, buybacks, and then taking some gains in the energy space. Quickly going through those, buybacks is the theme that we continue to like. We've owned that since early November. That has outperformed the S&P of about 250 basis points in that time frame. We like this theme, but where we've seen a lot of companies across the board announce some very aggressive buybacks, we think that's something that we already have exposure to. And again, felt like there were some more attractive satellite opportunities. The mid-cap high quality space, that's one where we added for diversification benefit. Interestingly enough, mid-caps have lagged the S&P, although that high quality tilt that we have had performed right in line. Again, mid-caps just haven't really worked. And so felt like there were more attractive opportunities elsewhere. Last one, the energy play, been one of our probably best trades. We added that in mid-December. Since 12/14 through last Thursday, that position had appreciated over 24% during a period of time where the S&P has been negative. Energy is a sector we do still like. We've seen some very encouraging earning results. Valuations are still very attractive relative to the broad market. That was something, though, just based upon its absolute stellar performance as of late, felt it prudent to take some gains that had triggered or hit some technical sell disciplines, but absolutely expect us to re-engage that position if we do have some volatility in energy stocks that present a more attractive re-entry point. And thought process when you think about deploying those proceeds, again, in international, so where you have now started to see interest rates in the international space tick higher, That puts downward pressure on the dollar, making those international investments more attractive. Additionally, financials, as we talked about, again, hasn't necessarily translated to a steepening yield curve, but broadly speaking, as interest rates go up, that is still a tailwind for financials. We see that. We own a satellite position in banks as well. Both of those are trades that have done very, very well in their respective holding periods. Looking to the week ahead, this Thursday, we get CPI data. No surprise there. Expect analyst expectations still over 7%. Do think if we get a reading in or around that, market will be comfortable. Again, we've talked about some of these systemic changes that I think longer term are still to put downward pressure on inflation. Don't necessarily anticipate any of those occurring overnight. The other piece, though, if we get a unexpectedly higher inflation reading, that would obviously then further fuel some concerns in the narrative for the Fed to take a more aggressive action. But we think reading right around the 7.2 expectation would not cause the Fed to overreact based on what they've already communicated thus far. Last piece on the geopolitical front, we heard from Joe Manchin over the weekend, Democratic senator out of West Virginia, that Build Back Better is dead. That was tied to those inflationary concerns. The other piece that keeps a lot of folks awake at night is that continued escalation at the Ukraine border. Impossible to forecast what are the probabilities of that. Interestingly enough, you've seen the Russian stock market start to recover somewhat. Again, the hope there is that peaceful resolution will be reached. One of the trades that we wanted to add that we really, really like from a fundamental and evaluation standpoint is European financials. That was one, though, if there is a escalation at the border, we've seen some very aggressive sanctions be announced. And we were thinking European financials, as well as Europe as a whole, would likely struggle based upon that relationship with Russia. But financials, especially when you think about some of those sanctions, tend to be more economic in nature. So that was a position. Couldn't get to a point where we're comfortable adding. We'll certainly continue to monitor very, very closely. And then in other news, likely should have seen the invitation for the March 3rd webinar. Very excited to have an opportunity to interview LPL's Chief Market Strategist, Ryan Dietrich. Per the invite, the agenda there. Again, going to run about 30 minutes of just asking him some predetermined questions, getting his different views on markets and process and approach. If there's anything you'd like to make sure that we get asked in that segment, please don't hesitate to email those questions over in advance. That's all for now. Again, thank you for taking the time to listen this morning. And as always, please let Michael and myself know if there's anything we can do to help. Take care and have a great week.